Hello and welcome to Bazaar Morning Call. I'm Prashant. With me, my colleagues Reema and Nigel. Good morning, guys. Things are looking much better, right? I mean, the smile tells it all. Reema. US equities are up, 3 to 4%, and it's looking good overall. You got the dollar index, which is down. Yields are down even more. I mean, the dollar index is at about 106, but US Treasury yields saw massive declines. And I think we are coming off with that late, powerful surge that we saw in the Nifty in the last 30 minutes. So this should only help incrementally at the margin. The fact that what has happened overnight is very, very positive. Although I think it still yields to debate whether the moves in the US will continue. There are lots of disagreements. I mean, actually completely opposite views, which we will talk about with regards to the Powell's speech yesterday and how markets interpreted that. SGX Nifty is indicating, I think, a slightly 77 point higher, started about almost 19,000 this morning. Reema, hi. Nigel, hi.
Hi, and that would make us higher for the 8th consecutive day if we managed to close up in the green. And what a powerful rally that we had in the US markets. Just to take that point forward about the US 10-year bond yields, right now they're at 3.63%. Yesterday was 3.62%. This compares with 3.8% that it was pre-Powell speech. So we saw a decline of nearly 12 basis points in the US 10-year bond yield. And compare that with the peak level. That was nearly 4.32%. Even take a look at the terminal rate, the Fed funds rate, the peak rate that the market is anticipating. Well, now it's come down to 4.95%, hitting a peak in May of 2023. A couple of months back, the peak rate that the street was anticipating was more than 5%, which could peak out somewhere in June. So clearly, there has been that big dovish tilt in the market. And for our own markets yesterday as well, it was a very powerful rally. The sensex conquered that 63,000 mark. The Nifty closing at yet another record level. And look at the flows that we got. The FIs net bought 9,000 crore in the cash market. The DII sold 4,000 crore. I know a lot of it is to do with that MSCI rebalance, but still gross volumes massive.
Well, that's right, Reema. Massive volumes is what we saw, and that explains why we saw that big surge in the final hour of trade. But Prashant, how are you reading the entire setup?
I mean, positive, Nigel, right? I mean, there is absolutely no two ways about it. The price action tells you that, things are set up very nicely. So let me just quickly start from the basics with regards to what Jerome Powell said and what markets kind of interpreted or took off from that. So the first thing was he's kind of cemented expectations that the pace of hikes are going to be slower. It's not going to be 75, it's going to be 50. Now, you might ask, well, what is new? Actually, there is not very much new. But the fact is that throughout the statement, and I'm not going to go into every detail of what he said, he did not push back against what is very clearly easing of financial conditions, right? Which is asset classes are rallying once again. The US equity market, for example, has been in an you could call it a bear market rally, but a rally nevertheless. And markets rallying, any market rallying is financial conditions easing. So the Fed chair did not push back against that. He did kind of vow to, and I quote, stay the course until the job is done. In a way, he repeated a lot what he'd said post the last Fed meeting. He reiterated what others from the Fed have recently said as well. But the fact is, the speech yesterday did not raise any fresh alarm about inflation. I mean, it's not as if he said that, well, inflation is, too high and we need to do more. I mean, there was no incremental kind of pressure or alarm coming in from the Fed chair. And I think that is what the market took away. What next? You got the US jobs data, which is, on Friday. Between now and, the next 2 weeks when the next Fed meeting is, the FOMC meeting is, we will hear from many more Fed members. But I think, what he said yesterday, the Fed coming in from the Fed chair, this will stand. The fact that it's going to be 50, pace of hikes perhaps are going to be slower from here on. What do the US markets do? They rallied. I mean, the S&P 500, the NASDAQ even more. But just three things. These are technical indicators. And the reason I'm putting them out because they're coming together in a pretty constructive way. The S&P 500 has seen a monthly close above its 200-day moving average, one. You got the dollar index, which is closed just under the 106 level, 105.7 this morning. And WTI crude oil is seen what is known as a bearish outside month. We had two previous instances, one in 2020, the other in 2018, before this bearish outside month. And once we saw this, oil prices fell another 15%. That's why I'm saying, but of course, in 2020, when oil fell, everything else fell because it fell because, economies were shutting down, etc. In 2008, there was a recession risk. And so, what follows from lower oil prices in terms of implications for other asset classes we need to watch. Will it be the same kind of regime or will it be different? For India, because we are such a big importer, I think this is very good news because it helps macros, it reduces our import bill. What's the trade setup? Yesterday on the Nifty, we saw a huge surge, last 30 minutes basically. FII has bought 9,000 crores. That's over $1 billion. But you've got to put this in context because there was a MSCI rebalance, which we've been highlighting. I went back and looked at what JP Morgan's estimates were. They said the MSCI rebalance was expected to have an impact of about $961 million. So, you know, if this is anywhere close to even 900, what came in was about $1.1 billion. A lot of it, I mean, bulk of it was because of the MSCI rejig. The surprising thing to me was the price impact that we saw. Usually what happens is, you know, from the time that the changes in MSCI are announced to the time that effective changes take place, people, I mean, you know, funds warehouse these stocks and kind of, you know, the ownership changes hands in the last 30 minutes on the day when the effective change is to be made. So there is little price impact. There is volume impact, but not price impact. But yesterday we saw massive sort of price impacts as well. Nifty is broken out as a result of yesterday's powerful move above the upper end of the channel. What needs to be seen is if this is just a throwover, which is, I mean, you know, a false start in that sense, a false breakout or a genuine breakout. We'll find that out today and over the next couple of sessions. FII net long position in index futures is over 1 lakh contracts now. I mean, that is we've been saying this is a bit of an extreme, but does that mean that prices start to reverse? No, I mean, you got to wait for price signals to give you that reversal sign, and that has still not happened. Keep a trailing stop loss at about 18,539, 18,540 roughly in that zone. And of course, I mean, with yesterday's rally, the market has put a fair bit of distance between where we are now, where we're expected to start, which is about 18,900, and where that trailing support level really is at. I mean, looking good this morning, especially given the fact that US markets have seen this big break higher. Nigel, what are you watching?
Well, you know, Powell's speech is likely to power the Nifty closer to around the 19,000 odd mark. The question is, will portfolios start feeling it? Because the mid-cap index is still around 2% away from its 52-week high.
Yeah.
The small cap index is closer around 17% away from the small cap from its 52-week high. So portfolios are not really feeling it. You'll get a sense of that once both these two indices start moving up. Mid cap is within kissing distance, but the small cap index, you like that to get closer. Now we're entering into you know, today's December, start of December, and December has been the best month for the Nifty. You know, if you compare it with any other month, I did a quick study, I removed the returns for the last 20 years, and on an average, it's up closer around 3.2%, which is the best month. The other two are July as well as September. Now, the FIs in the F&O market, well, they added some longs, close to 7,000 long contracts, and they covered some shorts. On the short side, it appears there was some short covering on the Nifty bank, while on the Nifty, there were long positioning that was added. And on index options, well, they wrote puts aggressively. You like to see them adding long positions and as well as writing some puts, and that's precisely what happened. In case things go wrong, they bought some puts as well. That's a crucial data point now. The clients, they continue to add short positions. Even yesterday, they added 15,000 short contracts in the ratio of 3 shorts for 1 long position. So currently, clients which have been getting it right for the last many months, they net short on the index. But the FIs are net long and aggressively net long. Close to around 75% of their positions are on the long side. On the options side, well, they're writing puts at will. And that's why the PCR has moved to the higher end of the range, 1.55 odd. In the past, we've seen it go to 1.65, 1.7 as well. But now put writing is becoming very, very easy. However, yesterday, the call writers, well, they were taken to the cleaners. 18,600 call, 18,700 call. Between them, you had open interest shedding of close to 41 lakh shares. They got stuck on the wrong side. There was MSCI flows came in, and there was big unwinding out there. On the put side, though, that 18,700 put, well, that was very active. The premium out there is around 30 rupees or so, added more than 70 lakh shares. And given that today's expiry, the 18,700 put is the most important strike that you should be tracking, given the kind of open interest that we saw. Now, backed by the MSCI flows, part of this good news that we have got overnight, that could be, in the price, because we surged up close to around 80-90 points just in the last hour. Buy and dip strategy has worked, so why do you change that? You need to stick to that. If you get a bit of a dip, which I think we'll get at the opening tick itself, we like to see a gap up. We could see a bit of a dip, get into it. And the support zone, since we saw writing at around 18,700 put, well, the support zone is at around that 18,650 to around 18,670. SGX Nifty is indicating a flying start. But yet again, the portfolios have to feel good. So I'll be tracking the small cap and the mid cap indices. We need to see greater participation out there. Then you'll be feeling like Santa's coming to town and it's, we are at around 19,000 odd.
Let's give our viewers some hope, right? As you said, December has actually been a very good month.
Absolutely.
Last December, the Nifty gained about 2.2%. In December of 2020, the Nifty was up nearly 8%. And in the December of the prior month, which is just before COVID, the Nifty was up close to about 1%. So December historically has been an important month and a big month in terms of positive gains for our markets. And it's also going to be a very busy day. We've got auto sales to react to. It's the weekly options expiry. So today could be an interesting day, particularly in the last 1 hour of trade. And Asia this morning is off to a flying start. Hang Seng is up 2%. The Chinese markets, the Nikkei, that's the Japanese markets, are up close to about 1%. Strength seen in the Taiwanese and the Korean markets. So across the board, there is some amount of euphoria and strength that we can see in the Asian market. But let's get our viewers some equity calls.
Absolutely. This is Surendra Goyal of Citi, who says that domestic public capex spend is set to be at its highest since FY09 this fiscal year, and private capex outlook is improving at the margin given improving capacity utilization, further evidenced by the rise in loan growth trends to large industries. He says decline in crude oil prices should aid too. Citi adds L&T to their preferred list as they believe it remains well positioned to benefit from the improving capex outlook. Surendra says valuations for L&T also seem reasonable in the current market context.
Money market views now. Parul Mittal Sinha of Standard Chartered Bank says the rupee has been range-bound last week despite dollar weakness on the back of strong importer demand. She says given sustained dollar weakness post Powell's comments, she expects the USD INR to trade in a range of 80.8 to 81.8 against the dollar this week. Apart from the dollar moves, she says the trends in oil prices will be key given OPEC meeting is due this weekend.
Well, in bonds, we've got Parul Mittal Sinha, who says domestic yields traded in a tight range last week. She says the credit deposit growth wedge is expected to continue to put pressure on the short end of the rates curve, and the downward pressure on global rates post Powell's comment is likely to have a salutary effect. She expects the 10-year benchmark bond yield to trade in a range of between 7.2 to 7.35% this week. She says global rates and oil prices will provide cues to markets.
Well, we have a lot of stocks that will be reacting to news today, and we'll get to that in just a bit. But just to highlight what the stocks we're looking at IndiGlobe Aviation, Zomato, Dynamic Tech, Sanghi Industries, Shilpa Medicare, Tamil Nadu Mercantile Bank, KPI Green, Oberoi Realty, Suntech Realty, as well as ONGC. They are all the stocks that we're tracking on the back of positive news flow. And on a day like today, we expect we have not got any negative news flow, so we'll track all of these.
All right, so lots to really track in terms of specific stocks. But let's hear it from the man himself, Jerome Powell, who is crazy, right? I mean, he sets the markets on fire, causes markets to sell off. And of course, what he's done yesterday is triggered a rally, 3-4% rally in US markets and global markets as well. Listen in.
Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy, and I'll close by saying that we will stay the course until the job is done.
All right. I mean, when you hear the man himself, doesn't sound too dovish, does he? But market interpretation, of course, was dovish, and they did rally. Steve Bryce is Chief Investment Officer at Standard Chartered Wealth Management. He's joining us now. Steve, great to have you with us here. So the markets have rallied, a dovish interpretation, but is there a risk at all that, the next session, markets are going to wake up and say, well, hey, it was not that dovish. it was status quo. So there's no reason to be joyful about. What's your sense, Steve?
So I guess obviously people very focused at the moment on that 50 basis points implicit reading for the December FOMC. We do obviously have inflation numbers and also an employment report to come out before that Fed meeting. So we still have two data points that could swing us either way. Of course, it could swing us towards saying 50 basis points and not as high as markets are expecting next year, or it could swing us back to 75 basis points and a lot more. So the data is still going to be pretty important. We did have the latest labour market data, which did suggest a softening in hiring as well. I think that shouldn't be underplayed in this conversation. The Fed knows they need to slow the labour market to achieve its objectives, and the signs that might start coming through in the coming weeks and months. So I think that's the positioning at the moment. So 5% terminal Fed rate still seems there or thereabouts, I think. So that's what markets are pricing. But markets obviously at the moment very focused on the dovish read. But as you say, I think rates higher and for longer, or still higher and for longer, I think is still a challenging environment for equities.
Steve, morning. What is it that exactly positively surprised the street? Pre-Powell, the indices were absolutely flat. In fact, mildly in the red as well. And post this speech, you saw them rocket to gains of about 2 to 4%. Markets were anyway anticipating a step down. That the December policy meeting, we are going to see a 50 basis points rate hike and not 75 basis. So what is it that exactly positively surprised the street? And if we actually do get a 50 basis points rate hike, do you think there is an element of surprise still left? Can the markets continue to climb higher? What's the positioning like?
So I think actually that last point that you raised is probably why markets did well. It's more relief rather than the change in expectation. It sort of confirms what people thought was probably likely to happen anyway. So if you look at the equity market positioning has been very light. It's obviously been building in the past couple of months, but it has been very light. So it's just took less negative news to induce this rally. I think we're at really important levels today for the S&P. So if you look at the downward channel since the beginning of the year, we're right at the top end of that downward channel now. So we've done the easy rally. The question now as we move into 2023 will be, okay, we've seen valuations come down sharply this year, earnings still grow. Obviously, this has allowed valuations to move back up, but we do think that earnings are likely to surprise on the downsides. The consensus is 5% earnings growth. If we get the recession we expect, that's probably very significantly too bullish. So we could see those earnings expectations come down. So for now, we're still in a downtrend. We're at the top of that downtrend. We have concerns about earnings outlook. So we wouldn't be chasing this rally today, but obviously watching things very closely.
Okay. Hi, Steve. The last time as well, you said that you wouldn't be allocating any fresh money to equities, given the kind of valuations that we have and the headwinds that are placed with 2023 in mind as well. Is this still then, does this still qualify as a bear market pullback rally? Or do you believe we're getting into that bullish stance now?
I think because we're still in that downtrend, and we are clinging onto that downtrend by the skin of our teeth at the moment, it still looks like a bear market rally. Of course, if we were to break out of that downtrend, then that would change the picture quite significantly from a technical perspective. The fundamental picture, we're still not convinced is positive. The only thing I would say is sort of that would build the bull case, which is obviously not the side we're on at the moment. But if you look in history over the past 150 years, when you've had a very sharp downturn in a calendar year, usually over the next year, equities bounce. The only exception to that is 1931, where 1932 was also a down year. But every other year that we've seen, declines in the magnitude of what we've seen this time, we've seen a strong bounce in equities the year after. So even if we do get that recession, maybe that's a front-loaded weakness in the equity market. We see a much stronger second half, but the timing is very difficult to judge.
Steve, just a quick sort of take from you on what's the signaling effect of oil going to be? Oil is falling and falling sharply. Yesterday it gave out an important monthly technical signal, bearish, with bearish implications, a bearish outside month. The last two times it happened, in 2020 and 2018, This was accompanied by sharp fall in equity prices and a sharp rise in the US dollar. Do you think it's a different kind of place we are in right now, or the same could follow this time as well?
Obviously, it's not coincident, as you indicated, but I think the question is really, are lower oil prices a good indicator? Because they're obviously a loosening of global financial conditions. We obviously see that from an India market perspective as being really important as well, but it's also a global phenomenon. So from that perspective, lower oil prices are a positive, or is it a sign of weak demand and therefore that the economy is weakening? We clearly think we're on the verge of going into a US recession, which without any significant counterbalancing around the world, could be a challenging environment. We are seeing China obviously showing signs of trying to open up again despite rising COVID cases. So that could be a counterbalance to some degree at the global level. But we believe this is an indicator of weak demand and the challenges ahead for the global economy and particularly the US economy. So from that perspective, that's why we're still cautious on equities in the coming 3 to 6 months.
Cautious on equities over the next 3 to 6 months. Steve, one final question from my end. Are investors willing to chase India with the Nifty almost at 19,000 and the sensex well above 63,000?
Well, obviously, India has been the darling, or one of the darlings of Asia this year. So that's clearly been something that's helped. I think if China does start reopening, so if this experiment works and they can say, okay, despite rising cases, we can ease, then I think the shift is likely to be more towards Northeast Asia and China. So, yes, India has had a great year, and we expect it to continue to do well. We're overweight Asia ex Japan, but maybe it will not outperform like it has done this year.
Okay, all right, Steve. Thanks so much for stopping by and giving us your view on the global, market setup. Maybe, in fact, we're still in a bit of a bear market rally. And as you said, you'll not allocate fresh money to equities at these levels. For the time being, though, we slip into a short break. You come back, we'll focus on the top stocks that we're tracking for you.
Welcome back. Yesterday was a fantastic session for our markets, a powerful rally. The Nifty closed above 63,000. The Sensex at that 18,750 mark, higher for the 7th day in a row. And this morning, there is strength across the Asian market after Jerome Powell had a dovish tilt in his speech yesterday. Asia is strong, and the SGX Nifty suggesting a start with a gain of 0.5% above the 19,000 handle on the futures. But let's drill it down to individual stocks. Our entire research team is standing by. This is CNBC-TV18's list of top 10 stocks for the day. And first up, we've got Vivek joining in. Vivek, what do you have for us?
Well, quite a few stocks on our radar. First up on our list is Indigo and, aviation companies, on the back of the fact that jet fuel prices have been trimmed low by a little over 3%. Also keep on your radar Zomato. Now, yesterday there was a significant block deal. We had indicated that one of Alibaba's subsidiaries, Alipay Singapore, they sold close to 3% stake in the company. But very interesting when you're talking about the buyer was an arm of Temasek Holding called Kamas Investments. And this isn't the first time that Temasek actually has an exposure as far as Zomato is concerned. They already hold a 2.86% stake in the company via an other arm known as MacRitchie Investments. So expect some green as far as Zomato is concerned. Dynamatic Tech, some good order inflow coming in. The company has gone ahead and signed a 15-year long-term contract with an aerostructure company called Spirit Aerosystems. This is for the company's Belfast facility. And lastly, keep an eye out for Sanghi Industries. Some interesting news flow coming in there. The company has said that a board meeting has been scheduled on December 3rd. This is to consider various routes for fundraising. And just a couple of days back, in fact, the company managed to secure a loan from Kotak Special Situations Fund, where they invested almost 550 crore via the NCD issue. And this particular stock has been buzzing off late.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Ekta. She's tracking some more stocks that are in the news. Ekta?
Thanks for that. Well, yes, Shilpa Medicare, and I expect all of these stocks to be in the green. Shilpa Medicare, their Unit 4 in Telangana has received the Health Canada approval. This allows the company for commercial distribution of products in Canada. Remember, this particular facility had received a warning letter from the US FDA as well as an import alert. So maybe this Health Canada approval will probably give hope and fuel the market sentiment in terms of maybe getting a green signal eventually from other regulatory authorities as well. TN Mercantile Bank, they have been authorized for undertaking government business on behalf of the Reserve Bank of India. And KPI Green, the board has recommended a bonus issue of 1:1.
All right, Ekta, thank you very much for that. Now, Oberoi Realty, Suntec Realty are also in focus. Sonal is standing by to tell us why. Sonal, hi, morning.
Good morning, Prashant. Well, the numbers for registrations in the month of November for Mumbai real estate market are out, and they have shown a good growth. That's up 17% on a YY basis at 8,865 units in the month of November, which is a growth of 4% on a month-on-month basis. And if we look at the 11 months in calendar year 2022, that's from January to November, these registrations have already surpassed the registrations that were seen in calendar year 2021. Basis Jan to November 2022 data, as per Knight Frank, 2022 has emerged as the best year in a decade for real estate registrations. So good going for all these companies. So these stocks will be in focus today.
Okay, thank you very much for that. The strength in the Mumbai real estate market continues for yet another month. But let's talk about crude. Manisha is here to tell us more. Manisha?
Well, thank you so much for that. Yes, it's seen a nearly 3% of gain in the overnight markets. And as you were mentioning, it's about the U.S. Fed Chair Powell indicating a smaller rate increase ahead. U.S. dollar decline has been supportive, and so has been the Chinese demand expectations coming back. For the crude oil prices especially, it was the U.S. crude inventories, which also fell by a big one, 12.6 million barrels. Markets were anticipating a 2 million barrel of a decline. You saw 12 million barrel of a decline, and that clearly was yet another thing supportive. The other thing is that the OPEC meeting on 4th of December is now happening virtual instead of in person. That tells you that it's not going to be a long discussion or any big outcome expected as well. OPEC and allies may just about continue with the kind of cuts that they have already talked about, and that in turn also was supportive for the prices. For the month of November, we are still 7% on the weaker side, but for the overnight markets, it has been a huge jump.
Okay, got that. Thanks a lot for that, Manisha. Well, here's a quick recap of all the top stocks that we're tracking. Stocks with positive news flow. We have IndiGlobe Aviation, Zomato, Dynamic Technologies, Sanghi Industries, Shilpa Medicare, Tamil Nadu Mercantile Bank, KPI Green, Oberoi Realty, Suntec Realty, and ONGC. And a day like today, we don't have any stocks with negative news flow.
Okay, let's get you some important macro updates. India's GDP grew at 6.3% in the second quarter. This is largely in line with the CNBC-TV18 poll, which had predicted a growth of 6.4%. But it is much slower than the growth seen in the same quarter last year. Lata is here with the details. Lata?
Yes, in line with what even the Reserve Bank forecast at 6.3. But the GVA, gross value added, has grown by only 5.6%. GVA plus taxes minus subsidies gives you GDP. So it looks like a very good GST collection has made for good GDP. Perhaps the underlying economy is not as good as the 6.3 is indicating. Agriculture is clearly the best sector. 4.3%, much better than what anyone expected. But it's countered by manufacturing, which is contracted 4.3%. Contraction or flat was expected because, all those chip shortages, logistical problems starting with China and elsewhere, but not really minus 4.3. Made up for to some extent by services, where trade, hotels, transport and communication, the biggest employer in the whole GDP sector breakup, has grown by 14.7%. Now, let's not get carried away. If you looked at the actual output, it is 6.5 lakh crore that has come from this segment. Exactly the same amount was the output it generated in 2019, which means it's not really grown in 4 years, deeply hurt by COVID. You'd keep that on board. The other important point is on the other side, positive, private final consumption expenditure, excellent, grown by almost 10%, 9.7 to be precise, and capital goods grown by 10.5%, 10.4 to be precise. So consumption and capital goods firing, very good news. Government expenditure, disappointing, minus 4.3. That's a bit of a surprise, but possibly will get better because states will start spending in the second half. What does all this mean for the state stock markets? I would think, let me just concentrate on this exports. That's also a drag on the expenditure side. Imports are far higher than exports. So the net export drag from the GDP is double what it was last year, same time. What this probably means is that our consumption is very good, but we are consuming more imports. And that perhaps is a pain point, something for policymakers. Also, consumption being strong, but trade hotels being weak means that consumer discretionaries are clearly stronger than what consumer staples could be. The demand is on that side. Just a last word, CEA, The chief economic advisor said that GDP should be 6.8 to 7%. Looks like everybody is reconciled to GDP not hitting 7% this year.
Very comprehensive, Radha. Thanks very much for that. Actually, let's listen to the Chief Economic Advisor, Anantha Nageswaran, who had and what he had to say after the GDP numbers were announced.
Overall, real GDP growth in 22-23 is on track to be at the range of between 6.8 to 7%, and IMF maintains 6.8, RBI maintains 7%. And I think the more important thing is, if you look at the festival sales, if you look at the bank credit growth, if you look at the purchasing managers indices, whether it is services or manufacturing or the composite outlook, the economy has maintained its momentum, especially, I reiterate, in the face of very strong global headwinds and uncertainties.
All right, that's GDP here, but the big cue, of course, for markets is global macros and, of course, what the Fed chair overnight said. The point is economists and different market participants can listen to the same speech and reach diametrically opposite conclusions. Here is an example. This is Citi's economist, Andrew Hollenhorst, who says, and I quote, where the quote will come up for you, while most markets and participants have seen Jerome Powell's comments as bullish. All right, I think that is the preview. This is the quote. We disagree with the dovish market reaction to Fed Chair Powell's comments. The rise in risk asset prices, weaker dollar and decline in interest rates is probably due to hawkish expectations that had built up ahead of Powell's remarks. The assurance of a slowdown to a 50 basis point rate hike and the absence of a clear escalation of the hawkish message delivered at the early FOMC meeting, November FOMC meeting. The renewed easing of financial conditions only raises hawkish risks, including from Friday's jobs report. End of quote. I mean, that is interesting, isn't it? The point is, let's just hope that this jobs report on Friday confirms that even the labor market in the US is cooling off and the Fed remains satisfied, and it's not hot and prompts another U-turn from the Fed. But I mean, this is in line in terms of what I said earlier. It's not incrementally hawkish. The speech did not raise fresh alarms that they need to do more incrementally as opposed to what they've been saying they will need to do. For now, it's good, and markets are taking note. We'll come back with Gurmeet Chadha, Managing Partner and CIO at Complete Circle Consultants. He'll be joining in for some stock talk. Also, M. Kamakodi, Managing Director and CEO at City Union Bank, joins in to talk.
Welcome back. Hope you're having a good morning. Well, the SGX Nifty definitely is. It's indicating a big bump up of around 80 to around 90 points odd. Let's get chatting, though, with Gurmeet Chadha, Managing Partner and CIO at Complete Circle, who joins us. Hi, Gurmeet. Good morning. Well, things looking up, right? Market just flying away. But the giant has come to the party, actually, Reliance Industries. In the last 1 month or so, that stock is up between 7 to around 8%. What's your sense on it? There's a Jefferies note as well that's fairly optimistic on the stock. Your take?
So, Nigel, there was some Q2 disappointment, largely led by the OTC segment. While their upstream was good, I think what disappointed was the polymer margins, and lesser than expectation. I think the EBITDA fell almost 7% Q on Q on oil to chemical. While retail and Geo, I think, continue to do well. In fact, I was plotting the CAGR of EBITDA for retail also. That's at like 23-24%, which is in line with some of the retail players like DMart, and obviously they are on an acquisition mode. Geo ARPU, I think, will further go up as the 5G launch happens. I think the per capita subscription should also improve. But I think the bigger re-rating or value unlocking, if I were to say, would be when you'll probably see some monetization on the energy business, especially the renewable energy business which they are focused on, and maybe listing of Geo. They've also announced foray into financial services. So I think the bigger probably will happen when you see some of these corporate actions happen. In the near term, I think maybe with oil prices also down, there is an expectation that even the export duty on diesel, etc., will also come off. So I think remain constructive on it. It's consolidated now almost for a year in this range of 23 to 2700.
Gurmeet, morning. November registrations for real estate in the city of Mumbai is up 17% year on year, and it's up 4% on a month-on-month basis. So demand continues to remain strong despite inflationary concern, rising interest rates. Are you bullish on Oberoi Realty, Suntec Realty or Lodha? Any of these which look attractive to you?
Selectively, so I think Indians continue to buy more houses and more cars. I think that trend is visible month-on-month data on car registrations, on house registrations. In metro, I think we almost like in big cities, it's like a 6-7 year high. So we are tracking Oberoi. Since you are Delhi based, we track DLF also. And remain constructive on this space. I think, but what we like more in the long term, because we are on the fundamental side, is something which is more home improvement, where your balance sheets are more leaner, return ratios are better. So we continue to like the pipe segment, the cables and wires. I think Polycab has been one of our large holdings in the portfolio. It's done very well. With cable and wire business picking up. Their fast-moving electrical goods were a bit of a tad soft, but I think that should improve now in second half. That segment has grown almost now 35% for them in the last 4 years. Great focus on B2C. They're expanding distribution footprint, getting into more range on kitchen appliances, etc. And this is still a huge unorganized market as far as even the cables and wires go. So more those companies, even some of the cement companies now with price hikes, etc. So dominantly through the home improvement plays and selectively through the reality players.
Gurmeet, hi. Good morning. By the way, I heard you on the issue of Mercedes versus SIPs. I thought you made eminent sense, Gurmeet. Delaying gratification in favor of compounding is good, and that should be the way to go. But extreme delaying is also not good, right? You need to live life as you go along as well, along with, of course, your SIP. So very balanced. Gurmeet, a quick word on three names. These are all, we saw a big surge in, let's pull up Varun Beverages was up 14% yesterday. Valuations compared to historical averages were in any case at the upper end, but this is MSCI impact. There was Bajaj Holdings, that'll come up, something like a Tube Investments, so all MSCI by the way, but huge powerful moves towards close. Even Shriram Transport. Do these moves fade, or you think these are new levels? I mean, ETFs would have rushed to buy to match the change in the indices in the last hour yesterday, but are these new levels, or what's your sense? Do you like any of them?
So Prashant, what we've seen is, I think these are more event-driven news, like the rebalancing and inclusion, and entering after the moves have happened. Typically, is being counterproductive. And we do like Varun Beverages. I think it's a great franchise, great ratios. We also like another concern of theirs, which is the same group, which is Devyani, which is a master franchisee for Yum brands. Including KFC, Pizza Hut, etc., and the coffee chain, including Costa. So we like some of them. Also, I think they're a great reopening play. We made this point, and there's a huge marriage season, huge travel going on. Tourism has picked up, and a lot of it will have a rub off, on them in consumption. So obviously, Varun Beverages probably it's a little more cyclical, with summers probably being more dominant versus H2, but the portfolio is being diversified. We continue to like even Tata Consumer. I think some of the FMCG names might come into action as raw materials soften, and I think inflation data will surprise big time once you get into January, February. I think, and my personal sense is, I've been traveling. I think it's a little more pronounced than what is being reflected in the numbers, whether it is US or whether it's in a lot of pockets. The rural recovery looks a little, some uptick, we are seeing there. So I think that could play on the FMCG numbers as well. So some of the food names like Tata Consumer, selectively, and maybe Adani Wilmar, etc., they are on our radar.
Gurmeet, do stay on. We've got a corporate conversation to go to. City Union Bank is on our radar. The company laid out its guidance in the conference call recently. They are looking at a loan growth of 15 to 18% for FY23, and they expect margins to remain about 3.85 to 4%. The company also expects the asset quality to improve significantly by the end of the year as slippages come down. N. Kamakodi, the MD and CEO of City Union Bank, now joins in. Mr. Kamakodi, morning. Rima here. Your loan growth in the first half of the year has lagged the industry. You are expecting things to pick up in the second half of the year, which is why you've given that guidance of 15 to 18%. Can you tell us where the growth is going to come from? Up until now, it was a lot about gold loans doing well for you, metals, textile. Can you give us details segment-wise? Where is it that you are seeing growth, and where is it that growth perhaps is pausing or faltering?
If you remember the way back in 2019, November, December, after the con call, we said things were not going okay after the, even it was before the COVID times that we are taking our legs off the growth pedal. Then after that, the COVID hit and things were, let's say, not okay. And we thought things will be improving towards the end of the financial year 21 and 22. But the uncertainties about the inflation, oil price because of the war and all postponed things. But things improved with the, let's say, last quarter, significant improvement we were able to see, at least on, let's say, the expectation wise. The major change is that the impact of the oil price war or inflation and all were not as deep as it was expected at the year beginning. And the capacity utilization, that is one thing which is slightly getting delayed is the capacity utilization. Normally, when it crosses about 85% or so, the investment cycle will start. We were expecting the investment cycle to start. Maybe it's getting delayed by a few months or whatever it is. So the things are not as bad as originally we thought at the beginning of the calendar year, but significant improvement. And that's why we said we will be improving, which will be towards the end of the current year. So we still believe that, let's say, we should be closing the year with about 15 to 18% growth. Slowly and steadily, things are improving. But one, let's say, the factor which is not happening as per as per our expectation, our investment cycle should have already started based on the anecdotal evidences and discussions we had with our customers and all, which is getting slightly delayed. Still, the capacity utilization is just touching the pre-COVID level, and at least 4-5 percentage points improvement is needed to see the investment cycle coming back to. As you suggested, the gold loan is really doing well. So, taking into consideration all these factors, we expect we should be closing the year with, as suggested, between 15 and 18% for the year end.
You said the investment growth cycle has been pushed forward versus your expectation. What are your corporate conversations like? Is this in the larger enterprises? Was it in the mid-size, the smaller size? Some more color on the statement that you made, sir?
Yeah, we are basically bankers for the small and medium scale enterprises, commercial trading and agriculture. We are not into large corporate side. Even in the mid segment, we are seeing now a lot of discussions on investment in the, particularly on the solar and other renewable energy and all. Basically, we were expecting, let's say last year, perhaps the textile industry in this part of the world, particularly in Tamil Nadu, saw huge opportunities and positivity. But currently, later, because of the cotton prices and all, some amount of minor sluggishness in the things are there. Based on that, we were getting a lot of particularly discussions on the, I mean, people have started discussing about the, let's say, capacity increase and investment in the renewable energy and all. But as per our expectation, originally the things investment should have already started, but it is getting maybe postponed by a couple of months or so. So we are still expecting we should be able to get into that bracket of 15 to 18% for the year.
Okay. Hi, good morning, Mr. Kamakodi. You know, in the last 48 hours, the big news we got is the Tata Group, they're consolidating their, their airline business. And that could mean that a bigger competitor is out there, which could mean not such good news for SpiceJet. At least that's the broad understanding. Now, SpiceJet has exposure to your bank. Could you give us a sense? The payments are coming. What is the total outstanding? Or have there been any delays?
See, the basically, as you know, our exposure to SpiceJet, I mean, we had never been into financing large corporates in the past. Like, that's why even when the AQR cycle started in the banking industry, we were not hit because we were not having exposure in that segment. Our exposure to SpiceJet basically started with the previous promoter, who is our long-standing customer. So here, in fact, we wanted to exit them. We had, like say, originally about exposure up to 100 crore. After we recalled the advances, they have repaid up to about 15 crores or so. They have given their monthly schedule up to, let's say, June 2023. Up to now, whatever commitment they gave and post-dated checks they gave, they have been making the repayments on time. So the as we had suggested, we had made cushions for provision for that particular account. So far, so good. Like say they already they have clearly spelled out their plan, and the repayment from SpiceJet is as per their commitment, the agreement which we entered a few months back.
All right, very quickly, Mr. Kamakodi, you have reiterated that 15 to 18% growth is what you're targeting. Until now, SpiceJet is honoring all the payments. So that's good news. A quick question on your NIMs. They're already at the upper end. So can you maintain it at these levels? And ROAs, earlier you were talking about around 1.5%. You've surpassed that. What's the trajectory on both these two fronts?
See, basically, yes, you are right. We expect we should be having the, closing the year with 15 to, 18% bracket is what the confidence we still have at this point of time. And on ROA front, we typically had 1.5% plus for many years. So we, when the COVID struck on the financial year 20, we closed the year with 1% ROA and took everything over and above that as the provisions. And we slowly saw that increasing to 1.15 and 1.35, and we said we should be getting back to that 1.5 ROA for the financial year 22-23. Yes, we had. Basically, our expectation is that, even though we expected things to happen in the second half, we could see that happening in the first half. So we hope we should be having year as a whole. There could always be quarterly aberrations and all, as we have seen in the past. Year as a whole, we expect we should be able to touch our pre-COVID level of 1.5, around 1.5, whatever we have seen now.
Mr. Kamakodi,
in terms of
Mr. Sorry, apologies. We're just running into market opening, but we got it, and profitability in the second half will continue to remain very, very solid. Appreciate you joining in, sir, and hope to have you back again for an update once I think we have the third quarter results with us. That's sometime in January. Thank you. We'll take a very quick break here. Just 12 minutes to go for the pre-open. Sudarshan and Mitesh are going to be with us. Welcome back. 9 minutes to go for the pre-open session. So let's set it up with Sudarshan and Mitesh, who are joining us as always. Gentlemen, good morning. Great to have both of you here as always. So another gap up after yesterday's very powerful last 30-minute surge, Sudarshan. Do you wait for a dip to get in, or do you think this is kind of starting to look a little bit like a frenzied move higher, which can add a couple of 100 points quickly?
Good morning, Prashant. See, this is a bull market and it's an uptrend. And sometimes we perceive a loss of momentum. Sometimes we see a frenzied move. These are all parts of the normal activity of a strong uptrend. So the basic point remains that we should be on the long side of the market. For the intraday traders or traders who wish to enter today or on any day in such a bull market, the simple trade is buy on a minor consolidation or dip. These minor consolidations or dips come intraday, and then put a 100-point stop loss and stay on the long side of the market. Now, the banks have not participated in yesterday's rally. They have actually been in a trading range for 5-6 days. This can be construed in so many ways, but we will still assume that the banks are as bullish as the Nifty is, because there is no evidence to the contrary. So if you are looking at a bank, buy the bank with a 250-point stop loss, or much easier, simply buy the Nifty on an intraday consolidation with a 100-point stop.
Okay, all right. Got that, Sudarshan. Mitesh, good morning. What about you? How would you approach Nifty? I mean, what a super close we had. And today, the SGX is indicating a follow-up. How do you trade it then?
Morning. We've been having some kind of long exposure, and I think just been trading the stop losses. The latest level would be around 18,650. That becomes the trading stop loss. Let's see if the opening gap up doesn't get immediately sold into, then I think we'll continue to carry long position. But in case the 60-70 point gap up, if we start trading below yesterday's high, then I think I would be willing to take more profits and then wait out for some kind of a pullback to play out. So I think markets are very overbought. That's my only worry. But otherwise, we've stated targets of around 18,900 should be met today, and eventually targets of 19,950 to about 20,000 on the upside, which is with a medium-term perspective. So overall setup is long, but tactically, I think I'm slightly more inclined to take profits given that hourly charts are on the overbought side.
Sudarshan, what would your specific trades be?
Well, the trades are again on the mid caps because we cover the large caps when we buy the Nifty. Cummins is a buying opportunity. Cummins has been going up consistently, as have been many good quality stocks. Consider it just broke out again. Buy with a stop under 1376. JSW Steel, again another consolidation, then subsequent breakout. Buy with a stop under 731. Chola Finance is my only intraday short. In short selling should be done only intraday. Sell this with a stop above 722. And DLF, same pattern as the earlier mid caps. Rally, consolidation, breakout. Buy DLF with a stop under 390.
Okay, all right. Sudarshan, thanks for those picks. Mitesh, what about you? What are the picks you have for us?
So I have all buy calls today. DLF is also on my list. That's a buy with a stop at 395, targets of 415 here. There are about a couple of metal names. Hindalco is a buy with a stop at 444, targets of 465, and Jindal Steel and Power. That's a buy with a stop at 527 for targets of 550. Colgate is the final call, buy with a stop at 1615 for targets of 1665.
Indeed, yesterday the metal index in fact was higher, and today, given the kind of cues that you have, maybe softer interest rates going ahead. You have the dollar index as well, that's corrected close to 100%, or it should bode well for the metal index. And a couple of picks that Mitesh gave us was Hindalco as well as JSP.
Should watch for IT as well, right?
IT,
After that powerful 4.5% rally on NASDAQ, there's usually a follow-through that we see in the IT space. So metals and IT could be the two sectors to watch, and particularly in the last half an hour, as this is the weekly options expiry, we would be tracking those large banks like HDFC Bank, which tend to have that 3 p.m. move as well. But just 5 minutes left for pre-opening. It's expected to be a good start. We're poised to continue with the rally for the 8th consecutive day. Get into a break. We'll come back with the pre-opening rates. We'll also be joined by Probal Sen of ICICI Securities to discuss the Kirit Parikh panel recommendation. Stay tuned.